While everyone is watching AI stocks, the actual mechanism controlling your portfolio just broke. I'm looking at a mathematical divergence that predicted every major market correction, and it's happening again right now. This is the CDX High Yield Spread. It measures fear in the credit markets. While retail investors are euphoric, credit is cracking and it's breaking higher. But the shock absorbers are gone. By the end of this video, you will see exactly how a crisis in the Middle East triggered a chain reaction that is forcing a liquidity cascade in US equities. Let me show you the dominoes. Domino 1 is oil. With the Strait of Hormuz compromised, Brent crude oil has spiked over $100 a barrel. For the US, that is a painful inflation, but for Japan and Europe, it is an existential threat. Japan imports nearly all of its energy, and when oil spurges, their trade deficit explodes. To survive, they must raise capital, and they have no choice but to liquidate their crown jewels. And Japan owns over $1.1 trillion in US Treasuries. Which brings us to the second domino, the repatriation. So to defend their economy, Japanese institutions are bringing back capital by dumping overseas bonds. $34 billion worth in February alone. Inflation and inflation expectations are driving the 10-year Japanese government bond yield to a 2.25%, the highest since early 2012. The carry rate is officially dead. So if the largest foreign buyer of US debt is suddenly selling, US Treasury yields must rise to find new buyers. And over the last 2 weeks, the US 10-year yield has spiked 35 basis points. This yield spike triggered Domino 3, the dollar wrecking ball. Higher US yields act as a magnet for global capital spending, and this sends the US dollar index vertical. So according to the Bank of International Settlements, there is over $65 trillion in hidden off-balance sheet offshore dollar debt. When the dollar surges, every foreign entity that borrowed in dollars is hit with a synchronized margin call. To service that debt with more expensive dollar, they must liquidate assets, and this creates a massive global liquidity drain. This liquidity vacuum mechanically compresses stock valuations, pushing the S&P 500 down, which triggered Domino 4. Everyone assumes the market will gently correct, but it won't. Because the vulnerability is exponentially worse today than previous cycles, and today institutional cash positioning have collapsed to 3.4% and there is no dry powder left to buy a dip. So almost every manager is huddled on one side of the boat with zero margin of error, but it gets worse. As US equities drop from yield shock, they cross into what we call the short gamma firing line. In March 2026, the S&P 500 fell below the 6,808 gamma flip zone. When option dealers are trapped in a short gamma, they are mathematically forced to sell into downward pressure to hedge their own books. There are no buyers, only mechanical selling fueling more selling. This brings us to the mid-video pilot and the final trapdoor. So before we show the paralyzing trap that Federal Reserve just walked into, make sure you're subscribed. We are tracking this liquidity drain daily, and you cannot afford to miss the next signal. The counter-argument is that the United States economy is booming, and the mainstream believes in a no-landing scenario, where the Fed will just cut rates and print money like they always do to bail out the market. And to be clear, if oil prices suddenly plummet thanks to a peace deal in the Middle East, this entire framework collapses. Rapid disinflation would allow the Federal Reserve to immediately cut rates and rescue the markets. But that is hope-based strategy. The data reveals a very different reality. Look at the revised GDP data. Fourth quarter economic growth was just downgraded sharply to 0.7%. Consumer spending is rolling over, business investment has flipped to a contraction, and the fundamental engine is stalling. And because oil is stuck above $100, this slowing economy is colliding with the sticky inflation. Consumer inflation expectations just surged to 4.2%, so we're entering a stagflationary death trap. Growth is collapsing, but inflation is accelerating. The Federal Reserve is paralyzed. They cannot cut interest rates to buy out the equity market, because doing so would only pour gasoline on the inflation crisis. We have reached debt saturation. In 2019, a few $billions rescued the repo market. Today, it requires exponential liquidity just to tread water. Look at the corporate bond ETFs like LQD breaking multi-year support trend lines. The liquidity is gone, credit is cracking, and the Fed's hands are tied behind its back. Earnings cannot outrun systemic insolvency. The dominoes are falling in order. Oil crushes Japan, Japan sells US debt, USCL spike the dollar wrecking ball drains global liquidity and crushes stocks. Stocks trigger the short gamma avalanche and the Fed is trapped. So what is the exact trigger? Watch the Federal Reserve FOMC decisions for a reluctant pause, and watch the 6,880 support level on the S&P 500. If the US index sustains a break below that gamma flip zone while Japanese yields hold above 2.2%, the mechanical liquidation begins. This is your warning in advance. Thank you for watching, see you in the next one.